Microsoft, the company that didn't only completely recover from the recent stock market crash, but is hitting a record high. With a valuation of $1.5 trillion, it seems like it will be one of the first companies to cross $2 trillion valuation. But how much your money would worth if you have invested just $1,000 in Microsoft's IPO? As of 2018, your $1,000 would have turned to $1.6 million. And in the last 2 years, the stock price more than doubled, so you would have earned much more than that. When you think about passive income, you'll probably imagine real estate and that type of income. But the stock market isn't just about the price of the stock, but also a way to earn passive income. When you buy a stock, you're literally becoming an owner of that company. One stock isn't going to give you that much influence over the company, but nevertheless, the company is obligated to share with you some of its profits, and that is called a dividend. Some companies pay a lot of dividends, others not that much. In the case of Microsoft, it's $2 per share, or a little over 1%. If that doesn't seem like a lot of money, let me tell you that some companies don't pay anything like Amazon or Facebook. Over many decades, Microsoft has proved itself to be one of the best investments ever. Its revenue has been increasing consecutively every year, with $125 billion just last year. It's sitting on a cash pile of $136 billion, with no signs of slowing down. The company is founded on the basis of innovation. Despite the success of Mac, it's still widely dominating the computer market, with Windows being almost on every computer. It even began producing its hardware in recent years. If you know anything about Amazon, you know that the backbone of its success is Amazon Web Services, where Amazon provides on-demand cloud computing platforms, and it's controlling 1/3 of the market. But do you know who is the second biggest player in that market? Yup, you guessed it right, it's Microsoft. Although dividend yield isn't high at Microsoft, it's still there, and the company is growing at an unprecedented speed. I won't be surprised if it hits a $2 trillion valuation in the next 2 to 3 years. So if you want a super safe investment that's growing tremendously and pays constant dividends, you should be looking at Microsoft. The second on our list is Johnson & Johnson. You're definitely familiar with this company. In fact, it's one of the oldest companies out there. It's a huge medical business with multiple companies under its wing. Its products are on the shelves of every country all around the world. The stock price hasn't been growing as some of the tech companies out there, but it's the king of dividends. For over 57 years in a row now, it has been increasing its dividends and has been one of the safest investments you could make. Annually, they pay a dividend of $4 per stock, which is a dividend yield of 2.75%. That's more than what some of the largest corporations pay. I know that some of you aren't impressed yet because that barely beats inflation. However, you have to consider that the safer the investment, the lower the returns are. It's also working on creating a vaccine for the current pandemic. If it succeeds, its stock price might soar as well. In the case of Johnson & Johnson, historically speaking, for 6 decades, it hasn't just been paying dividends, but kept increasing them. So if you're leaning on investing long-term, Johnson & Johnson might be one of the safest passive income stocks out there. The third on our list is also a tech company. It's a company that manufactures your favorite smartphone. Yes, I'm talking about Apple. This company doesn't need an introduction. You probably know a lot about it. But let's take a look at its dividend yield. Currently, it's a little lower than 1%, or $3.28 per stock as of May 2020. Don't be scared by the fact that it has such a low dividend yield. The problem is that the stock price has been increasing so fast that you have to take a look at the context. For the last decade, Apple had a 2% yield. Sometimes it was higher, other times it was lower, but it was around 2%. And the company is in such a great shape that even after losing around 30% of its value due to the pandemic, it's back and is hitting a new record. Since the invention of the iPhone, the company's revenue kept increasing year after year. Even though the smartphone industry has stopped growing in recent years since it has reached its limits, the company still managed to keep its revenue at $260 billion last year. The company is focused now on taking over the budget phone sector with the introduction of iPhone SE. Of course, a $400 is still expensive, but Apple holds a brand name that people around the world value and are ready to pay the extra, even if it's a budget phone. The pandemic illustrated to us that it's one of the safest companies in the world and nothing would stop it from growing. Even though it might be paying a dividend of just 2%, you can be confident that on the other side, the stock price is also increasing, making you wealthier. The next on our list is Lowe's, an American retail company specializing in home improvements. The company operates a chain of retail stores in the United States and Canada, and as of November 2018, Lowe's and its related businesses operate 2,000 home improvement and hardware stores in North America. It's the second largest chain in the US. Founded in 1921, it has been growing since then. If you take a look at the stock price, you realize that in the last 5 years, the stock price has doubled. Although it suffered tremendously due to the pandemic, like the companies we have mentioned previously, it recovered quickly. It was one of the first companies that suffered most by losing half of its value overnight. Currently, it has a dividend yield of 1.7% or $2.2 per share, which is not bad for such a stable and safe investment. These companies might not seem to have a high rate of return. However, you have to consider the fact that, first of all, they are safe compared to the rest of the market, but more importantly, their stock is also growing. For instance, Lowe's stock in the last 12 months increased by 30%. It was also paying a dividend, so you're benefiting from the rise of the stock on one side and also having a passive income flowing into your pocket. On top of that, you're confident that your investments aren't going anywhere, since it's a strong company and the current pandemic is the proof of that. And finally, the Home Depot, the largest home improvement retailer in the United States, supplying tools, construction products, and services. It operates many big boxes format stores across the United States and its territories of Guam and the US Virgin Islands, all 10 provinces of Canada, and 31 states and federal districts of Mexico. Compared to the rival Lowe's, it pays a higher dividend of $6 or 2.34%. In the last 5 years, the stock price has increased from $110 to $254 when writing the script. With strong financial statements and $110 billion in revenue last year, the company is looking forward to taking advantage of the digital world. The company has been investing in digital channels with One Home Depot initiative that it announced in December 2017. The dividends of these 5 companies might not seem impressive, but when we are talking about passive income, you want something safe, something you don't have to look after every single day. There are many companies that provide much higher dividend yield, but the stock price can crash overnight, and those high dividends won't make up for the losses of the stock price. That's why this list is made out of the safest companies in the market that pay some dividends and are growing over time. When you buy a stock, it doesn't bring you any tangible value. You just hold it and wait for someone else to offer you a higher price for it. And when you make the sale, then only you profit or maybe even lose. However, I want to point out that just because one company pays a dividend doesn't make it a better investment than other companies. If the company would not pay dividends and reinvest that cash back into the company to grow it faster, maybe that's a better option. Amazon is a perfect example of that. Until today, the company hasn't paid a dime in dividends. Even after 3 stock splits, the Amazon stock price is $2,600. investors clearly made a much bigger return on the stock price than if they would have received dividends. And that's it for today. I hope you guys have enjoyed this video. If you want to support us, you can check out our Patreon page. Thanks for watching, and until next time.